Hi, I'm Debbie Lewis, and today we're going to talk about credit scores. You know, it's so important that you know what your credit score is so you know if you're getting charged the right interest rate. Now, interest rates and credit scores go hand in hand for everything. Your house, your car, heck, even your insurance now checks your credit score. They figure people with better credit take better care of everything. They probably drive a little safer, they take better care of their things, and that's just an overview, but truly if you have a good credit score, you're a little bit more dependable, and let me explain why. Credit scores are very interesting, how they work and what makes a good credit score and a bad credit score. This is what I lecture people about every single day. And lecture is what kind of I have to do because the rules keep changing on what makes a good credit score. Let me read you some of the things that I found about credit scores. When you make an application for credit, the credit lender uses your credit score, and you've got three of them: Experian, Equifax, and TransUnion. Now you're going to ask me, why do you have three credit scores? Well, competition, number one, and other credit reporting agencies report credit differently. So physicians, healthcare providers, hospitals tend to pick one credit bureau and report your credit there. So even though you have three scores, you'd say, well, all of my credit's the same. No, not really, because if one of the credit bureaus uses medical and the other two don't, and then you have medical as a bad credit, it's going to bring that score down. So in the mortgage world, for example, we take all three and we use the middle credit score. We don't average them, we just use the middle score. But on a credit score that I pull for your credit report, I see everything. So on some of my credit cards, I've had them since I was in college back in 1982. The longer you have credit with one company, the more heavy your credit score is with that company. So let me explain. A credit history, the scores are going to range from in the low 500s to around 850. Now, that's going to change the older you get, because if you are a middle age to older, you're going to have years and years of established credit. So it's going to be very beneficial if you've had a couple homes and paid them off, had several cars and paid them off, and they've been on the credit report, because the whole top of the credit report is everything that's active. The second part of the credit report is everything that's paid off, free and clear and good standing. And the very bottom of the credit report is all the derogatory credit. That's going to be your collection accounts for medical, cars, any repossessions, foreclosures, or bankruptcies. Your account history and inquiries into your credit are example of credit information and how they're going to calculate the score. Let's talk about, you've got three credit scores. Fair Isaac Company is the FICO score. It's used by many creditors, and what goes in part of your credit score is very specific. Payment history is 35% of your credit score. That means if I've taken out a Dillard's or a Sears credit card and I've continued to pay them on time, Visa, MasterCard, or even my car, that payment history counts for 35% if I've made it on time or if I haven't made it on time. It's still 35% of my score. Late payments, collection, and bankruptcies all affect negatively your credit report. Debt level is 30%. So let's say you have a credit card that has a $1,000 limit and you're always charging about $800 on that every single month. Well, depending on when we pull your credit, you could be up at 80% of available credit, or if you pay it off, you could be zero, and that means that you have 100% of available credit. It's very bad for your credit scores to be at 50% or above. That means if you have a $20,000 charge limit on a Visa card and you have a $10,000 charge on it, or you carry that type of balance, you're not getting the full benefit of that if you paid it down. You should always have a big bunch of room, at least 30% credit used, but not 70% of your credit score used. The amount of debt you have in comparison to your credit limit is known as credit utilization. And the higher your credit utilization are, the closer you are to the limits, the lower your credit score is going to be. Which means that if you've got every card maxed out, then they understand, the people that do the credit scores understand that you're having trouble because you don't pay that credit down, and that hurts your credit score. Length of credit score history is 15% of your credit score. So that's why we say when you're getting a mortgage on a house, it's better to keep those accounts that you've used forever on your credit and don't close those out. Don't go getting any new credit, because that actually goes against you. You're opening new credit. You should be having old credit. But eventually, you're going to have too much old credit, and you can let some of that go. But when you're looking for a car or house, that's not the time to do that. The longer credit history is favorable because it gives more information about your spending habits. It's good to leave accounts open that you've had for a long time. So don't open a lot of new credit. Keep the old credit that you have. So if you ever walk into a bank and they tell you to delete all those old credit accounts, that's going to harm your credit report score, not make it better. Inquiries are 10%. And what's an inquiry? Every time you make an application for credit, you get an inquiry and it's added to your credit report. Too many applications for credit can mean that you're taking on a lot of debt and that you're in some kind of financial trouble. If you're applying for credit card after credit card after credit card, that means, why do you need so many credit cards? Why do you need so much credit? Are you not able to make your payments? Are you talking about switching one balance to another? That's not good, and they figure that out. Mix of credit is 10%. Having different kinds of accounts is favorable because it shows you that you have experience managing a mix of credit. This isn't a significant factor if your credit score is if you don't have much other information on which to base your score. You can open new accounts as you need them, but not simply so that you have a mix of accounts. Don't do that. And how to check your credit score, there's a lot of ways to do that. There's also factors that make up your credit score. You want, for the mortgage world at least, a 720 or above gets you the best interest rates going. So whether it's 720, 760, 780, or 810, you're still going to get the best rates in the insurance and mortgage business when it comes to approving your credit. Anything below 720, there's kind of a matrix, and that does change per lender, so that 680 to 720 is not the best score, but it's not the worst. You have to have a minimum of 580 or 620 with most lenders to do an average FHA loan. Credit Karma is a good place now to look for your online score. You can also get a free score online. That's freescoreonline.com. You also may want to inquire. You get one free credit report score per credit line. So if you are with TransUnion, you can call them and get your score once. Equifax once. And Experian once, one time a year. If you have more questions about credit and you need to email me, let me give you my email address. It's Debbie@DebbieLewisShow.com. And thanks so much for being with us today.